Hey there, thank you for joining us for another real estate industry update. My name is Kyle Paxton. I'm a senior tax manager with James Moore and Company based in the Gainesville office. I'm here with Daniel Roccanti, who is a senior tax manager based out of our Tallahassee office. We are both members of our real estate team, and we are well versed in like-kind exchanges, which is what we're here to talk to you all about today. We're going to cram as much as we possibly can into a video, so bear with us as we power through some stuff. But we're going to hit some of the basics, common mistakes we see, and some trends we've seen here in recent years. To start, I'm just going to touch on a couple of the basics around like-kind exchanges. I think if you're familiar with real estate and kind of in the real estate industry, at least the concept is familiar to you. IRC Section 1031 outlines provisions that allow you to qualify for the deferral of gains on the sale of your property. This is restricted now to just real property, and it only qualifies for property that's deemed to be like kind. This is defined as kind of the nature of and character of the property, not the grade or the quality of the property that you're selling. And with that like kind piece, it's really embodying real estate in general. So you can sell a farm that you're using in your trade or business of farming and acquire a commercial rental property. That's still deemed to be like kind. The key there is that both of the properties must be held for their productive use of trade or business or their investment in nature. So no personal properties. There's rules kind of around when they flip between rental and personal in various years. That's outside of the scope of this video, but just know in basics, any property that's held for the use of trade or business or investment qualifies for this treatment. The big thing you remember with like kind exchanges and issues we run into frequently is the dates. So you have 45 days from the sale of your first property or the sale of the property that you're exchanging to identify replacement properties. And that has to be issued in writing to your qualified intermediary. And then you have 180 days from from the sale of the property to actually execute closing. And Daniel, so there's an extension to the deadlines available, correct?
That's right, Kyle. Taxpayers who were affected by federally declared disasters are getting extensions, and this happens with the like-kind exchange. So if you're an individual or you have a principal place of business located in these federally declared disasters areas, which currently right now is Florida, South Carolina, and North Carolina because of Hurricane Ian, they're getting an extension. So if you have a deadline date that falls on the disaster date or after disaster date, this will be extended to February 15th. That means that 45-day period or 180-day period will get extended all the way to February 15th, which is a pretty long time, so that you can get extended to make sure your like-kind exchange goes through. If you don't live in one of those areas or have a principal place of business, you still might get this extension if the like-kind exchange you were trying to do was in one of those places. So if you were a non-resident in one of those states, but you were trying to buy a property in one of those affected areas, you could still also get this extension. Or if you're having difficulties meeting one of these deadlines because of disasters, you might also be eligible for this. Now let's go into more of the back into the rules of the like-kind exchanges. So to have a fully deferred like-kind exchange, you want to try and avoid having any kind of positive boot. Okay. So normally there's three rules. You want to try to purchase a like-kind replacement property of equal or greater value than the relinquished property. You want to invest all the net equity, that's exchange funds, from the sale of the relinquished property into the replacement property, or you want to obtain debt equal or greater on the replacement property than that was on the relinquished property. Okay, if you meet these, you'll most likely get all of your gain deferred. But if you do have positive boot, what will happen is you'll have a partial gain. You won't pick up the full gain, but you will pick up the gain equal to whatever boot you received. So if you received boot of about $50,000, then you could have a gain of $50,000 or up to $50,000. Boot is usually cash. It's not always. It can be closing costs. It can be debt that was assumed or paid off. And the key here is to make sure that you do not have positive boot. Okay, but there's common mistakes like dead boot that Kyle is going to get talked more into.
Yeah, so we see a lot of common mistakes with this. It's a complicated tax area, and we work, each of this it's a really intentional decision to go through this exchange, and there's a lot of loopholes you have to meet, so we have to make sure that it makes sense for you in your situation. So The one thing I always want to preface common mistakes and things with is that with any tax planning strategy, a lot of times we find clients get so caught up on the buzzword, right? Like kind exchange, 1031 exchange, it's what everyone's talking about. I want to do it. You have to make sure it makes sense for you economically first before the tax, the tax implications. Make sure that makes sense for your full economic picture. What pulls into all of that is a lot of tax concepts. Like if you already have current year losses or loss carryovers that can help you mitigate some of the gain you would recognize in just a straight sale of your property, it may make sense to go ahead and do that. You're always entertaining various tax rates, making sure that what you're doing is optimizing your effective tax rate and that you're getting the most bang for your buck there. If you have a built-in loss on that sold property, a lot of times we'll see people start going through this process and then find that you don't even have a gain to defer, right? So it's all there's a lot of front end planning involved to get a lot of that. And then, as Daniel referred to, any money you received in this through this process represents boot, which is going to trigger gains for you. So you have to be mindful throughout that you never touch the cash that comes through the like kind exchange. It is given straight to a qualified intermediary, which I'm going to touch on here in just a second. But none of that boot comes out into your own hands. You take it, give it to the third. I'm sorry, you don't take it. It goes straight to the third party, and the third party remits it to the for the purchasing property. And so the qualified intermediary is a very important piece of this topic because the qualified intermediary is that middle person that this is all functioning through. So the qualified intermediary is an independent third party, and it's designed to assist the IRS with these transactions in that helping with tracking swaps, right? Keeping everything in line and what's being swapped for what, and making sure the parties involved are all qualified and things like that. So the qualified intermediary, again, the key is an independent third party. They have not been an agent for you in the past. Your CPAs, your tax advisors that are doing other tax planning for you don't qualify as qualified intermediaries because of these limitations around being your agent. And so there's no related licensing. There are some boards that oversee the practice and things like that, and a lot of specialty firms out there that do this type of work. We're always happy to refer. We have a lot of good contacts in this space, but just understand a lot of times we see confusion around who the qualified intermediary is, and I, as your tax advisor, cannot serve in that role. And again, just to drive that point home, the key there is that they're holding the cash during that exchange period, so it never touches your hand, which would trigger gain. And so, a big piece of this too is that you are completing the like kind exchange within the same reporting entity. Daniel, can you talk to me a little bit about that?
Right. So as long as you're doing everything correctly, and if you're using a good qualified intermediary, they should know this stuff, but you should also be using the CPA. So just remind yourself there's three parties: you, the taxpayer, the CPA, and then the qualified intermediary. Normally your CPA will not be both of those. It can happen, but most of the time it's a whole third party that should be helping you out with these transactions. If you want to make sure that you're getting all your gains deferred, you need to also know the rules of how like-kind exchange works. And the first is that it has to be done in the same entity, okay, or the same reporting entity is really what it is. And so that means the replacement property and the relinquished property has to be bought and sold within the same entity, okay, reporting entity. So that means if you're filing on your personal return 1040 or you're filing on a business return like a partnership, that just means that reporting entity has to be the one that sold the property for the like-kind exchange and then purchased the new property. But when I say reporting entity, why that matters is basically you can have disregarded entities. So say you have an LLC, okay, that's a disregarded, that's 100% owned by a separate entity, so a partnership. Okay, well that partnership is a reporting entity. So you can buy, sell within other LLCs. So these are technically legal entities, but for tax purposes, this is all one reporting entity. So you can do this with single member LLCs too. So a lot of people buy real estate in a single member LLC, which just means it's reported on your Schedule E on your personal return. But because of that, you're the reporting entity as an individual. So you can buy and sell and use like-kind exchanges through your disregarded entities as long as it's all still being reported on you. But this also creates complications. So let's say you have a partnership And you have some partners that want to do a like-kind exchange and some that do not. Well, now you have a problem because the partnership is the one that does the like-kind exchange, not the individuals. So it can get really complicated. So this is where planning needs to come in. There's certain things you can do, like buy the property in tenants in common. So instead of buying it in a partnership that produces a business tax return, that you actually technically buy each by an undivided interest in the property, and then you would report that interest. So let's say 3 people bought it, 1/3 each, into their own individual names as tenants in common. That they will record a third on their Schedule E on their 1040. So this could create complications, but what does it allow is it allows each one of you to make your own decisions on a 1031. So say 2 want to do a 1031 exchange, 1 wants to not do one, that's possible. Okay? So if you get yourself into a complicated situation when you know down the road, hey, like-kind exchanges happen, some of us are not all on the same page, you might want to talk to a tax advisor and basically say, what planning can we do so if this scenario happens? Or let's say you're in a scenario where you already have a partnership. Well, there's technically a way you can drop it all down into tenants and commons. You're going to have to get definitely an attorney involved in that. But there is complex and complicated ways that you can get around that and still try to do like-kind exchange if you have some people that want to do it and some that don't. Now, there is other easier ways, like say you want to do a like-kind exchange, but you're tired of cleaning toilets yourself and being the landlord. So maybe you want to try and do a like-kind exchange, but you want to be more passive. Well, there's also passive instruments like a DST that Kyle's going to talk about.
Yeah, I love DSTs. I'm seeing it a lot right now with my clients. A lot of people are interested in this, and I could talk to you about it all day. You could see the little spring in my step, right? But we'll keep it short and sweet. High points here. As I said, they're very popular right now. It functions. Delaware Statutory Trust functions as an investment vehicle that qualifies for the like-kind exchange. So what you're doing is you're acquiring an interest in the underlying property in this Delaware Statutory Trust or properties. It can be multiple. And so common occurrences I've seen are you may have a multifamily property in Florida and a multifamily property in Virginia. So it could vary by, and you own 1% of those properties. The idea is you invest in these the underlying properties. The key here is you completely lose control over the property management and your funds. So when you invest in these vehicles, whoever is managing that DST maintains full control of your future with this pool of money, right? So generally, we see these last up to 10 years. You get an annual return each year on the rental income of the properties, and then somewhere in that 5, 7, 10-year range, the property sells, and you get that windfall coming back to you. So there's it's really we're finding it's really good for our clients, for those that are at quote unquote retirement age, right? That are trying to scale down some of their rental activity, maybe their main business, the underlying property there. They're trying to slow down that activity. They like the idea of continuing to invest in real estate, but they don't want to have to deal with the management of it. So it's really good for a lot of people. You know, each DST will tend to have kind of a minimum contribution into it, and there's a lot of requirements around that. But the key that makes this really nice is that those DSTs qualify for the 1031 like-kind exchange treatment. So you can defer gains by investing in these. It looks a little weird because you don't get, if you're familiar with investing in a business, a pass-through entity, you get a Schedule K1 to report the activity on your individual return. These are a little unique in that you treat it as a property that you are renting yourself on Schedule E of your individual tax return. Your share of the income and expense items, depreciation that's adjusted for your basis in the property from the like-kind exchange. But all of that activity is reported on your individual return as if you actually own that property individually, which you do. The other thing we see that's outside of the like-kind exchange realm, but we're seeing a lot, Daniel's going to touch on for us, is qualified opportunity zones, which is another vehicle for potential gain deferral.
Yeah, so qualified opportunity zones, we're going to talk shortly about this since this is a like-kind exchange webinar, but we do want to mention this because let's say you're trying to do a like-kind exchange and 45 days go by and you identify some properties and then you're unable to close on all of these. Well, part of you is like, well, dang, well, now my like-kind exchange fell through and I got to pay taxes on that. Well, what do I have other options? You absolutely do. An opportunity zone could be one of them. Because the rules are completely different, you have about 180 days to also complete a qualified opportunity zone, but you do not have a 45-day identification period. Okay. And also, you are allowed to touch the funds. So we mentioned before, the like-kind exchange, the qualified intermediary has to hold the funds for you and then use it when you buy the new property. Well, in this case, you can actually have the funds. So say the qualified intermediary is like, I can't find anything from you, all your days have passed, and they send the funds back to you. Well, your like-kind exchange is dead at that point, but you still have other options. So an opportunity zone could be one of them. But there's a lot of different tax treatment. The biggest one is that I know that it is only deferred until 2026. So unlike a like-kind exchange where it's deferred indefinitely until you sell the new property, then you can do another like-kind exchange and defer it indefinitely again. That's not the case. If you use the opportunity zone, it's only deferred to 2026. Okay, so that means the tax is due. But then there's also additional benefits where the investment in the new investment, okay, is now if you hold on to it at least 10 years and then you sell it, you receive 100% step-up basis. So that means that, hey, I could potentially save even more money on my new investment, but I still got to pay taxes on the old one in 2026. My money's going to be tied up. So you're going to be paying the taxes with different sources of money because your money's tied up, knowing that in the future, you're going to have even better potential gains. So the characteristics are a little different, but it could actually be better in your situation. And also, you only have to invest your capital gains. Unlike a like-kind exchange, you have to invest the total amount of basically proceeds that you have into the new property. In this one, you only have to invest the actual capital gains that you receive, meaning that you can keep the basis of the proceeds that you receive. So you can still keep some of the cash if you want it for others. And then, of course, you can hold on to the money. So these can get very complicated. So if you ever are interested in this, absolutely talk to some advisor. But this just might be something. Yes, yes. And not even all CPAs will deal with these opportunity zones. So it just needs to be someone that is a sophisticated taxpayer that understands this. But do realize that if your like-kind exchange falls through, there is other opportunities. Now, if you're doing a like-kind exchange, we've only been talking about the federal side, but there's also a lot of state side. Most states, you have to file a state tax return as well. So, Kyle, what's the state implications when you do a like-kind exchange?
To be clear, I'm far less excited about talking about this, just as a general. So we've invested a lot of energy, time, resources into state tax the last couple of years. It's becoming more and more complicated. Every state applies tax differently. Like-kind exchanges are no exception to that. There's a few different buckets, right? And all I really want you to take away from this video is that it is complicated and there are a lot of rules and you need to be paying attention to them when you're going through this. So just to use kind of a quick example of an issue you could face is if you're selling a property out of California and you're acquiring a property in Florida, right? California has what's known as the clawback provision, which means that when you go and sell the property in California, they're going to honor the like-kind exchange like they do federally. You acquire a property in Florida, you go on and you make another like-kind exchange into another property. California is not going to forget you. You can extend this indefinitely federally, but California is going to come after you and get their tax from the gain on the property that you first sold in California. So just understand both on the selling and the purchasing side that the states that you are doing this in, and the same applies for the DSTs. It's really important to pay attention to the rules in those states because you could potentially be subject, and unfortunately you potentially could be double taxed in multiple states on some of these transactions. Daniel, take us out of here. That's plenty on like-kind exchanges.
Well, we appreciate you guys stopping by for this webinar today on like-kind exchange. We hope that you learned a few things, and more importantly, we hope that you were able to save some taxes and put some of your own money back in your pocket. If any of you ever need more information or need some advising or consulting on like-kind exchange, please reach out to us here at James Moore & Company.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.